Thank you very much. I feel very happy to have this opportunity to come over to talk to you about our perspectives regarding real estate, financial investment, and we'd like to share with you the thoughts and the perspectives of the domestic investors as well. Maybe I'm gonna speak in Chinese. We have more audience who understand Chinese, but my English, slides are in English. So as a matter of fact, speaking of the real estate sector and the China investors and investment that is related to real estate, there are several types of them. For example, the residential property, commercial property, and a property for development purpose, and also mortgage-backed security and REITs, etc. So for each topic, I can spend a lot of time going into details on each topic, but I'm gonna spend the next 5 minutes zooming in on the residential property in China. What about the mentality and the mindset of those investors in this regard in China? So from my university team, working with Wharton Business School and Tsinghua University, so this is like the joint research. And for the entire world, it begins to pay attention to opportunities arising from China's real estate market. There are several reasons, because China's real estate growth contributes substantially to the worldwide real estate growth. And then, as we know, in 2013, the output value of the real estate amounted to 6% of the nation's total kind of output. And then the construction industry added in another 7%. Then you should also buy furniture among other facilities, all those that are related to, let's say, property. The share of expenditure related to real estate as a share to GDP is over 40%, 40, meaning the real estate has a big bearing on China's economy. Over the past decade or so, the prices are changing quickly. For example, land price, actually on average, it increased by a factor of 7 over the past decade, especially for Tier 1 cities. For example, Beijing, Shanghai, Shenzhen, Guangzhou, especially Beijing, actually over the past decade, the land price skyrocketed by over 1,000%. However, in many cities recently, we observe the situation where, for example, there is less supply than demand. If Chinese investors deploy their capital making offshore investment, there will be some implications to their mentality when they are doing overseas investment with the capital. With Wharton Business School, Tsinghua University, and my university, we compile like a China Land Price Index. So if we look at 2004 as the baseline of 100, by Q2 2016, the index is over 1,000, actually. So namely, going up by a factor of 100. And of course, as we can see here, around 07, yes, there was a hike, then hit by the mortgage crisis, then dropped by the end of 2008 and the beginning of 2009, the 4 trillion stimulus package, then it started to go up, then on and on average, up by 675%. The annual growth is around 16.5 times. And of course, there is different situation across the board, across different regions in China. If, for example, 2004, the baseline in Beijing is 100, then it goes up to 1,000 as an index by 2016. In Chongqing, the growth of the price is slower. This is an American price index. The organization I used to work, the FHFA, the American organization, their index. So as we can see, over the past 25 years, the price went up by only 2.5 times. So if Chinese investors, for example, actually have the mentality or expectation of the annual increase in house price of around 16%, then you do investment in America. You should be ready, psychologically speaking. This is commercial property indices, actually the decade period or 2 decades period, 300% to 400% kind of a hike. The next, let's look at the house price index that has been rising quickly. For example, from 2006 through 2013, in Beijing, there was an increase by a factor of 3.5. Other cities like Shanghai, it went up 152% with an annual increase or compound growth rate every year exceeds 10%. The next, we actually overlay land price with house price. Domestically, actually, the house price hike is pretty much driven by land price going up. So in Beijing, actually, the land price is 4.6 times that of the house price increase, and 3.4 times in Shanghai. So in China domestically, the house price hike is pretty much driven by land price increase. Then, demand and supply balance. The existing market, so you may not be able to get a clear visual on the small fonts. We divide them into over a dozen markets. So we look at the existing stocking level for each market. Then we do the math according to the annual sales value. The vertical axis is 250. So the existing stocking, actually, through a period of 2 to 3 years, that will be sold out. So this is a long-term equilibrium because according to the press coverage from the rest of the world, saying there are bubbles actually that are ready to, for example, burst in China housing market. But we look at the last group, the supply and the demand ratio from 2001 through 2010, then from 2010 through 2014. The last row is, for example, the third period. So nationwide, there is an equilibrium between supply and demand. So if it is over 100%, meaning there is more supply than demand. So in Beijing, the ratio is only 87%. So this is for Guangzhou, 92%. 79% in Hangzhou, falling short of 100%. 70% in Shanghai, meaning there is less supply than demand. 72% in Shenzhen city, but there are some cities, for example, Chongqing municipality, close to 300%, meaning in that city, supply way outweigh demand. And also cities like Chengdu, which witnesses, let's say, 230%. So in a nutshell, there is a balance between supply and demand. However, with the exception of certain cities where there is a severe, kind of a preponderance of supply over demand. Then let's look at the ratio between price and the rents, the P ratio in finance investment. So in the States, when I worked there in the United States, usually speaking, South California market, for example, they reached like 16 multiples to 20 multiples. In China, many cities where there are 50 or 60 multiples. So actually, the inversion ratio is cap rate. If it is 60, the cap rate is around 1 point something. So if we make investment with that mentality, so how come the PE ratio is that high, but there are still investors who are willing to go ahead with a decision to invest? Because the sentiment or expectation of the market for the next year growth, for example, Beijing, if the market estimates next year is going to secure a 7.3% increase, then this price is likely to go up. But actually, over the past decade, what is the annual price increase in Beijing? On average, it was 20%. Year in, year out, it is way more than the expectation. So from this index, the Beijing housing prices will continue to rise. It will not drop. But for expectation value, it is fragile, meaning if there is macro-level control from the government, for example, the cooling measure, the March 17th cooling measure that is promulgated lately, if there is one percentage drop in the expectation. If the expectation thinks growth drops to 6.3%, then the equilibrium housing price is going to decline by 35%. So this is a big risk exposure. So why I mentioned those China housing indexes? Because in some places in this country, there is already more supply than demand. Therefore, some investors, developers, and the general public wants to deploy their capital overseas. But overseas, actually, the PE ratio in this circle is 16 to 20, where Chinese people are used to a higher multiple of 50 to 60. So with that in mind, with that mentality, if you make overseas investment, you're going to have to adjust your mindset. So, of course, this is only a basis for more discussions later on. Thank you.
Thanks so much to Professor Deng from NUS in Singapore for setting the scene for us there. This will be our final panel before we move into our close here at the WBEF. And joining us up here on stage, may I welcome Yongxing, who is the General Manager of Wenhui. And also up on stage, Rob Young, who is a real estate lead at Asia for KKR. From Malaysia, Mr. Nur Hisham Mohammed Yusof, who is a Federal Commissioner of IRDA. And as many of you know, Dr. Lian, who is a past president of the RICS. So welcome to everybody. And we're going to be talking about attracting Chinese capital in this last session. So we want to understand some of the practical factors behind investor decisions in markets outside of China and to identify high-level solutions that ease capital flows while maintaining a responsible approach to investment itself. Obviously, as we all know, China is a leading source of foreign direct investment, both in infrastructure and real estate. Last year, those numbers alone, we saw China's total overseas investment into commercial real estate setting a new record high of just shy of 40 billion US dollars, which was up 49% from the year before. Those figures came from DTZ and also Cushman and Wakefield. So really, we start off by asking ourselves what gives Chinese investors confidence when looking to invest in key markets. Dr. Ong, maybe you can start by telling us why do they feel so confident? I hear about people who we all know about people who buy property unseen now. They just go online and they've been recommended and there they go.
I would like to take a few steps back, just looking at how the progress has been for Chinese investors over the recent years. Just when there was an economic reform way back in the late 70s, China was attracting or was looking for foreign investors to come to China to invest, to take up developments and properties and so on. And then when we move into the 90s, by the time we get into the 90s, we begin to see there is some movement of capital from China out into the international market. I remember in 2000, just about 5 years ago, in 2012, when we met in Beijing, I remember I said that there is going to be an increase in cross-border investment. No longer you see the trend of capital coming out from the West into the East, but you're going to see a multi-flow of capital between the East and the West, and mainly not just from the traditional market like Japan, Hong Kong, but you're going to watch out, money is going to come out of China. At that time, I didn't know that the central government is going to relax the capital outflow. And lo and behold, over the last 3 years or so, we see that tremendous outflow of capital from China to invest in properties across the globe, not just, you can see in London, in New York, and in Australia, and also in some of the emerging economies, Africa, and in Southeast Asia as well. And so the trend has been phenomenal. And that shows the tremendous progress over such a short period, that China has become not just a goods exporter, but China has now become a capital exporter as well. And so that really tells us of the confidence that China now has, not just within their domestic market, But with their economic management and also with the understanding of where the market, I thank Professor Deng for highlighting some of the issues that will be real issues that we need to confront and to be concerned with. But that shows that the Chinese investors are beginning to discern, able to evaluate the risk profile of the different markets, and to be able to put money where it is able to generate money. You see, the whole philosophy about Chinese investors is that they want to put the money where it can grow. And I think they now are able to develop with the understanding of the property market, the cycle, and the geopolitical situation, the risk that is involved. And I think Chinese investors are getting smarter, and they will know where to go in. I think this is where we are at this point in time.
So you call them smarter. I mean, Rob, what do you think? Do you think that that's true of the market in general? Do you think that they are pretty confident about domestic and also overseas as well when they are going in as investors?
Sure. Well, first of all, thanks for having me here. My day job at KKR is primarily investing Western capital into China. For the past 4 or 5 years, we're starting to facilitate some of the outflow of capital from China to the rest of the world. I think what's really important to keep in mind is that the Chinese real estate companies, particularly the larger and listed ones, are truly best-in-class developers in the global stage now. Think about the volume that these developers have to build on an annual basis. It's unthinkable for a lot of developers in other countries. And for everything you do, practice always make it better. So when you're building millions of square meters a year, you tend to get better at it. So I think the Chinese developers now realize that they can develop and they can put money into real estate just as good, if not better than some of their peers in other countries, right? So I think that's where the confidence, or they're getting smarter, is coming from. But also, I think it's for every investor that's going abroad, it's for different reasons, right? So you have some who are more commercial real estate investors. They have essentially all their exposure in the United States. In China, they start going into the United States as part of way of diversification, right? Simply from a currency perspective, from portfolio composition perspective, is no different than global companies invest in China, right? They're diversifying their risk exposure to different countries, which is perfectly logical. And there are some others that's going into more developing markets. Just speaking with our other panelists, Country Garden, which is one of the biggest developers in China, are going into more developing markets in Southeast Asia, and that's because they can develop and they can build and they can urban plan better than some of the local developers. They have a competitive advantage, right? So it comes down to the reason why they're making those investments abroad. And again, every investor have their own different reasons, but I believe now the Chinese developers are becoming very competitive in the global stage, and that's the reason why they start going abroad.
Well, let's turn that over right now to another Malaysian, because I forgot Dr. Ong is Malaysian himself, but also the other Malaysian on our panel is Nur Hisham Muhammad Yusof, who works for Iskandar, which is this major development project linked to the government in Kuala Lumpur. Iskandar itself is in Johor, which is right across the border from Singapore. And in a way, it represents, when I think of One Belt, One Road and the New Silk Road Initiative, I do think of that kind of connectivity. Two very distinct cultures on two sides of the border, Singapore, Malaysia. But Johor somehow allowing those differences to blend in a little bit. It's not so distinct over there. Speaking about Chinese investment in Malaysia, there's been a lot in the tens of billions of dollars just in the last couple of months alone, as we saw the Malaysian Prime Minister and with the Chinese President, of course, and all kinds of exciting projects there underway. Before we talk about Iskander, but with the insight of that, what do you think excites Chinese investors? As Rob said, I mean, there's plenty out there to choose from. Obviously, they've come to Malaysia for different reasons, and they do find it familiar being there because there is a Chinese-speaking population there. There is a historical tie as well, and diplomatically too. But when you look at the nuts and bolts of a development park, a development zone, and real estate, what is it that's getting the investment over?
Thank you, James. I want to give a bit of context on this. And this applies to all developers, not just China. When they want to go abroad, I assume the first one they have to look is at the macro aspect. And Malaysia and China has had a relationship that's been way back from the 15th century. You know, at the time when Admiral Cheng Ho came to Malaysia. And there's a sizable community that is in Malaysia alone. And later on, the first Asian country to have actually a diplomatic relationship with China in the early 70s was Malaysia. So one of the things that I think is important for Chinese capital to come to a certain country is you have to look at whether or not there's a good G to G relationship. As you have rightly pointed out, the Prime Minister and both leaders have played a key role in actually coming and to promote the development itself. Even in the country garden, for example, in Iskandar, Malaysia, the royalty has a share in the development as well. So it's important to have a good G to G relationship, as well as have to have a very good partner when you go and invest in places like Iskandar, Malaysia, which is what I think country garden, people like country garden and Greenland and RNF has. The other aspect is for Iskandar, Malaysia as it is, as we have heard in the last, yesterday and today, it's important to have a vision for the regional development itself. In other words, the region that we are developing must have a good business concept to attract people to come, or else nobody will come. Now, and it goes without saying, one of the most important part is of any property development is location. And Iskandar, Malaysia being part of the route of the road and belt trade links, and as well as right next to Singapore, gives quite a good location factor for it to be looked at as a potential investment area. If you think about it, let's just look at the comparative values of the land in Singapore and Malaysia. In Singapore, you're saying about property for residential property is going at maybe 1,000 Sing dollar per square foot.
Roughly, what's that in US? Would you say
1,000? That's about
250
US dollar.
250 in Singapore.
In Singapore. Yeah. So now, if you look at this kind of Malaysia, which is just a causeway away, which is right in the border, the land prices there is about 300 ringgit per square foot, and that's not even 100 US dollar.
So that's what?
Yes,
just over a third of the price.
Yes. So if you look at it, if you look at the development opportunities in that area, and if you are marketing not to locals, you are marketing to the global audience. If you look at people like Country Garden, they are marketing. You have marketing offices in Dubai and in New York and in China. So they're not looking at just simply doing a development that is just actually targeted towards the local. They are going for the global audience. And because of the spending opportunities, the spending capabilities of other countries, that's what they are doing. And if you think about it, what happens if the accessibility between Singapore and Malaysia is improved? So now the problem is why there's such a disparaging in value is because the issue about accessibility between Malaysia and Singapore. But now, if you look at the Chinese government, they know pretty well that Malaysia are already talking to Singapore to improve accessibility between the two countries. So if you come in as a long-term investor, and you're talking about a time scale of 20, 30 years, and you know that over the near period that there's going to be improved factors like accessibility between Singapore and Malaysia and that sort of things. So obviously it's something that attracts Chinese developers into that area, and there's value to be made from here.
So you think that, I was going to ask you what Chinese investment brings to a particular project, because it's not ordinary investment. The scale is very different, the nature is very different, politically it's very different as well. So when you look at Chinese investment, I was going to say, what's the opportunity? What does it bring to that project? In the case of Iskander, do you think it applies a kind of good kind of pressure to encourage connectivity in a way that it's not present right now?
There's a few things that, yes, of course, it puts a lot of pressure on both Malaysia and Singapore to work out on things like this. But I think the other thing, of course, if you bring in big scale development, I mean, let's just see, I'm just quoting one example because there's quite a few examples. Okay, let's just say Forest City. Forest City development by Country Garden, they are bringing in not just values about value proposals such as creation of jobs of about 150,000 people, for example, which is going to be taking about local employment, sizable local employment there. They are also talking about developing SMEs and that sort of things. So when Chinese developers, they come to places like Iskandar, Malaysia, they bring along this type of value proposals, which not just appeal to potential investors of their development, but it also appeals to the government, and it appeals to, from a political point of view, it's also a positive thing on both sides. So there's a lot of things, synergistic benefit that can come from this sort of relationship.
Okay, let's talk to Wang Yongxing, who's from Wenhui, and I want to ask you about another aspect of Chinese investors. I mean, how do Chinese investors balance returns on investments that carry risks of their own? And we've been talking about risks throughout these 2 days, especially One Belt, One Road. There are many different countries involved. I mean, dozens of them at very different stages of development, you know, with unique risks that one has limited control over, including political risks and political instability. I mean, when you see it, and I know it's hard to generalize, but how do investors balance, as I said, the returns on those risks?
Thank you very much, the organizer of the conference. And after sharing the data from the professor, I want to say something from my own point of view. We have a lot of foreigners here, and we have a lot of young people as well in the conference room. Actually, the price change of real estate market is not something we are expected before. In the middle of the 1990s, building house, the residential property was not for investment. At that time, it was offered just for living. It's not a purpose of or a concept of investment. So at that time, nobody thought about investment in the residential building. But now, after 20 years, the function of real estate has been converted gradually, and now we focus more about the ROI, and then the real estate market start to form gradually. So in my generation, I'm not sure if you can remember, in 1997. When we had a financial crisis, our premier freed a tiger to the market, that is real estate. That means that the premier or the Chinese government would like to improve economy, stimulate economy by the real estate. And by a lot of fluctuations and going up trend, we are at the high level, a very high level of the marketization, the capitalization of the total real estate market. So what shall we do? How shall we deal with the return of investment issue. I want to give you an example. If you are going to buy a house and rent it, the return of investment of that investment is lower than the deposit in the bank. So that means if you just buy a house for rental, for rent to someone else, it's not worthwhile at all. But we also need to consider the appreciation of the value. So if you have expectation of a higher price in the future, your investment is still correct, although you do not make money from the rental. You make the money from the increase of the price, not from the rental. So you have to rely on wise judgment of the trend of the real estate price. Now China's capital market has accumulated to a certain level, so you have to invest, and this is the wish of the capital. The capital would like to invest in itself. So what's the direction of investment? The stock market, not very good, not very ideal. So the real estate market investment is very, very attractive. And that's why the government want to cap the real estate market for the time being. So, our company is doing QS and PM, and we have wide contact with the developers. And they work very hard to think about the way of investment. They want to maintain the value of their asset, and also they want to make more money from their capitals. So what's the target of investment? As you know, in the major cities, the land price is already very, very high, extremely high, and the government has a limitation of the land price. So that's why the capitals must go outside of China. So there are a lot of directions for investment. We have done a case before in 2008 when there was the financial crisis. I went to the United States at that year, and last year I also went to the United States. I visited Detroit. That city looked very, very poor during the financial crisis. When I was there in year 2000, I thought everything was good. But this year, when I revisited Detroit, I found that this city was in a very poor condition, and the asset price is very, very low in that city. So a lot of investors want to, acquire assets in that city, for example, buy the facilities, manufacturing facilities, to acquire their asset and localize the operation. I think that this is a very good way to invest. And also the moderator mentioned One Belt, One Road. Yesterday, we talked a lot about how to output our capital into the One Belt, One Road, and how to support the investment into the infrastructure. So the mission, if you have a look at the mission of ARIB, you can notice that when China has completed the accumulation of a capital, and when China has enough technology, it must export capital, export technologies to other regions of the world. So where to go? So the answer of our president is One Belt and One Road. In year 2013, I visited some of the western areas of China. I noticed the gap between western area and eastern area of China. And if you compare the western cities, western areas versus some of the less developed countries on the belt and on the road, you can find that western cities in China are much better than those less developed countries. So when we want to go to the One Belt and the One Road, we have to consider the risks of the investment. Of course, the security risk and the ROI, and also the conflict of cultures. I want to give you a very straightforward case. In one case, we found that there is a special religion in one area, and the working time is dependent on the time of worship, because when time is up, they have to do worship. They have to stop working and do the worship, and then it will impact the streamline of working, the streamline of or the working line. So we can't stop the line, but they have to stop the work to worship. So this is the example of a risk.
Professor, I don't know whether there's anything that you would add to what you're hearing, because you're the last, but also the first person on the keynote, but the last person here in this panel. If there's any points that you'd want to build on, but more importantly, what are the markets that Chinese investors are interested in today? I mean, you have this unique insight. I mean, what excites them? What do they find attractive, and for what reasons as well?
Yeah, of course, when you ask the question to Rob about whether Chinese investors are smart, Rob said yes, they are smart.
He said they're smart, I just agreed.
Yeah, I agree or disagree. The reason I say, Rob said Chinese real estate, especially the residential developers, are at least one of the best, if not the best in the world, because they have so much practice. There are so many demand for that. So one example is Wang has a joint venture development project with Tishman in San Francisco. It's a very successful one. But on the other hand, I disagree is Chinese developers are very good in develop the buildings. However, nowadays, the capital market, because today this panel talking about capital market. Capital market, how to dealing with the capital market, many major real estate developers are still less experienced, need to learn about. One good example is last year, we all know about the fiasco, about the attempt to hostile take over the Vanke trials. That shows even the developer like Vanke, they're still not very experienced about the real estate capital market. But that's exactly next stage. Of course, Vanke can continue to do those real estate development joint venture in San Francisco, in New York City. But they have to understand the capital market, how people play in the capital market in the real estate. That's the key part. That's related to like mortgage-backed securities, REITs, all those kind of things. I think there's very exciting transition going on, sometimes maybe brutal transition going on. The survival will be one of the best in the world. We may see some company maybe sort of disappear.
Okay. Do you agree with this, or?
Well, I mean, I think the professor is right, that the Chinese developers certainly are developing their skill sets as a hardware developer. The capital markets, I call them games, I wouldn't say just the real estate business. I would say most corporate in Asia in general are very vulnerable when it comes to the various capital market dealings, right? But at the same time, I would also urge people to think that when it comes to capital markets, volume and size plays a very, very important role, right? There's very little creativity you can do with a very small market, with a very small pond. But when the pond gets big enough, that's when the different type of capital markets activities can really thrive. And that's the reason why the United States capital market is the best in the world, because it's the biggest market. I think China is coming fast on that track, right? And both on domestic capital market, which is obviously enclosed, and I would say to a certain degree, a lot of developers are experimenting with the domestic capital market, and then they take the practice abroad, right? As far as whether or not some developers will disappear, I think that's survival of the fittest. That's not just real estate. That's anywhere around the world. Real estate, because of the capital it needs, magnify whatever strength or weakness a certain industry has to bear. I'll give you the easiest example. The large-size Chinese developers, when they issue high-yield bonds in the Hong Kong market, they're paying around 4 to 5% interest rate. The smaller developers are paying 11 to 12. There is no way that is sustainable. That gap of difference in capital costs will erode the smaller and mid-sized developers at some point. So yes, some of the developers will likely, you call it disappear, I call it consolidation. They will get consolidated by the bigger guys, but that's a competitive advantage issue, right? The market is determining that. It's not anything else that other than it's such a capital-intensive business. You need scale, you need expertise, and therefore the bigger guys are getting bigger, and the smaller guys find it difficult to survive.
Great. We're about the midway point in this panel, so if you've got any questions, we'd love to hear from you. It's going to be your last opportunity to do so at this forum. So again, utilize fully the app that's on your phone by going to the live Q&A section over there. Please keep those questions coming in, and we'll get them onto the panel and to one of our panelists as well. But pushing on ahead, I want to take the conversation in a slightly different direction now and look specifically at some of the currency issues, because the investment and funding aids provided by China to some of the emerging economies could be seen by some as the internationalization of the RMB. So my question would be, how would the RMB have an impact on other major currencies, such as the US dollar, such as the euro? Dr. Wang, what's your take?
You know, when China first, in a way, going into globalization in terms of engaging with world and supporting some of the emerging economies like in Africa, we also begin to see, Chinese government are beginning to fund some of these projects as part of G2G support. And you can see that in 2012, in terms of the transaction using RMB was only about 5% of the total trade. Predominantly, people are still using US dollar or euro as a trade. But by the time in 2016, you can see that trading in the RMB has gone up to 25%. And that demonstrates that there has been an increase in trade using the RMB. And that has elevated the profile of RMB vis-a-vis US dollar and the euro as part of international currency. And I believe in that regard, there is a huge respect on what the RMB can play in the international foreign exchange market. And I think this is something that we can observe, and it's going to increase more and more. Currently, in terms of bilateral agreement, has increased to about just over 20 countries, and there's a bilateral. They're using RMB as the common denominator for trade. But I think that number is going to increase more and more in the coming years.
Can I ask everyone this as well, including you, just to extend that slightly, in what way will the current capital control measures have an impact on Chinese investments overseas?
I think in the short term, there is going to be a shock wave. We begin to see that some private or individual investors are beginning to be nervous about this whole issue. But I think if you look in the long term, why this measure is taken, I think it's a cooling effect. It's a way I think the central government is trying to manage such a herd mentality in terms of resulting in such an outflow of the RMB. So I think it is going to be in the short term, but I think it's going to stabilize very soon. And I think as matters are under control, there's going to be a relaxation. There's going to be, because I think China is still very interested in the international market. And I think that the Belt and Road policy will continue, I think, in terms of support, in terms of investment, aids, and so on. I think this is just a matter of control measure to manage this current outburst in terms of capital outflow.
Okay, before we go to our questions, since we have the treat of having you here with us in Beijing, perhaps you'd like to tell us a little bit about Iskander. I mean, again, as we know, it's really on the border of it, and I just always find it so interesting, because also partly because I have some family from around there as well. But in Johor really is such a huge place. I think people forget about that, but they also, I think what's so interesting is that it's relevant to the conversation today about China and where this relationship is headed to, and perhaps Professor Deng can add a little bit over there because you're right across the border, right down the corner. Why don't you tell us a bit about this kind of first and you can build on it?
Okay, yeah. Actually, last night I was in Guiyang. There's a group of government officials. A lot of questions about Iskander asked me, say, what's my view about the risk and how do I encourage or discourage the Chinese investors to invest in that market? Since I live in Singapore for 8 years, we are good neighbors. I don't want to ruin my neighbor's market. However, as I grown up in China, as a Chinese, I would tell the Chinese investors, in order to do any cross-border investigation, you need to understand the market. You need to understand what the risk you are involved. You need to understand what the regulations that market is involved. Because what I saw in China, because I traveled to Shanghai, traveled to Beijing, I saw a lot of ads. The ads, the marketing sort of strategy, they per se, well, you can invest in Singapore neighbor, put the big Singapores, and then and then some of the Chinese ask me, say, well, Iskander is in Singapore or in Malaysia, but Singapore has a long-term relationship with China. There's a lot of Chinese government official training sent to Singapore. So Chinese market and population understand Singapore. So they thought they also understand the Malaysia market. But my advice is, if it's your hard-earned money, or hopefully it's not the money you borrow from your friends or from your bank, it's your money. If your money, hard-earned money, you invest in any market, you need to have a due diligence study, understand the market, understand the regulation, understand what the risk is before. I don't against invest in that market, but I encourage investors have more homework to have not just assuming Malaysia Iskander is Singapore. They are different market environment, they are different regulatory environment, there are perhaps different sort of the risk or different opportunities. So after careful study, I encourage the investment.
Okay. I know, sorry, I get a bit distracted because I feel something's about to fall on top of our head because I can hear someone right behind this screen all the time. Yusof, what will you tell us?
Well, Iskander Malaysia it covers about 2,700 square kilometers. So it's 3 times the size of Singapore, and that's one of the big advantages we have over Singapore because we have plenty of land and that sort of things. The opportunities of increasing the value is there. The other thing that is we're not just attracting Chinese investors. We have a business proposition. We have a long-term plan, which is important in any regional development. Our long-term plan covers about 20 years until 2025. We have a vision about what we want to do. We want to build a sustainable metropolis of international standing over there. And the Malaysian government, they recognize that they cannot rely purely on certain economic regions just like KL. They have to grow some of these other regions. And Iskander Malaysia is definitely one of the priorities that the Malaysian government put in actually trying to get this region to thrive as well economically. So there are 3 key facets of Iskander Malaysia. When we look at the development of a regional development in Iskander Malaysia, we are focusing on 3 key strategies. Looking at wealth generation. Of course, there's the economic part. You have to create the economic pie, and to do that, you have to create investment. You have to get investors to come, and China is a big part. In fact, China is one of the biggest foreign investor in Iskander Malaysia, followed by Singapore, and followed by United States. So there's quite a significant foreign interest in Iskander Malaysia. By last count, there are 32 countries which has invested in Iskander Malaysia. So that's creating the pie. The next part is how do we then share this wealth? Because in any regional development, for you to make sure that it's sustainable, there must be the local community as well as the local businesses. They must also be benefiting from the development. So that's the second portion. And the third part is what we call resource allocation. And this is looking at the sustainability portion. And we are the only, one of the things that we are doing in Iskandar Malaysia is looking at what we call this low carbon blueprint development. And this is something that we work together with the United Nations Development, United Nations, and we are also looking at what we deem as a smart city. I know during lunchtime there was a talk about what smart city is. We have our own definition of smart city. We are not technologically led. I mean, most smart city development, they've been led by technology, but ours is not the case. Ours is looking at the needs of the region and using technology to see whether or not the development can be enhanced using technology that suits that particular development. So that's how we look at the development in Iskandar Malaysia. So, and we focus on a number of sectors. So we very much, when we want to attract investors, a lot of, because of the priority of the government and all that, we are in a position to actually customize the incentives for foreign investors. I mean, Country Garden has got its own customized incentives. I mean, it's the only island that we're going to give a free zone. You know, so practically this is free accessibility and that sort of things. And because of that, there's and because the value, the coupled by the resources that we have, the talent we have. I mean, for China, for example, if we look at Iskandar Malaysia, 30% of the population are Mandarin speaking. So that also makes a lot of sense. You know, when you want to bring investment in, there are certain cultures that are common to the particular investor. So these are things that we look for when we try to attract Chinese. I mean that's my role here. I have to promote Iskandar Malaysia to any investors.
You're doing a very good job.
Yes, if you want to come, if you want to have any brochures or anything like that, I got plenty, but I brought along with me, so you can ask me later. But the other thing is, we are not afraid to share. If you want to look at what we call our comprehensive development plan, you actually can look at it, because we go to our website www.iskandarmalaysia.com, and you can actually download it, the executive summary, for free. But if you want the full version, you have to pay us $100 per copy, because we also have to sell that as well to make a bit more money on our side. So that will give you a flavor about what we're trying to build. When we talk about regional development, you have to look at many aspects of things.
Okay, so that's one example of what's going on in the region in which we are.
Can I just add on one aspect where Hisham mentioned? Within the section, there is development of education as an education hub. That has been one of the very successful part of the Iskandar development. We have attracted major universities, world-class universities into the EduCity in Iskandar region itself.
So you think that's been one of the
very successful, one of the early start in terms of projects that has been undertaken in Iskandar.
Okay. In terms of strategy, I just want to add on that. As I said earlier, there's a number of sectors that we are focusing on. 9 actually, 6 of them are service sectors. And the way the development is done is that for any of this particular sector, we try to actually bring in a catalytic investment. So for EduCity, yes, we have Newcastle University, Southampton University, we've got Raffles there. Tourism, we have Legoland. So those people who've been to Legoland, that's actually in Iskandar Malaysia, in case you don't know. We have the premium outlet, the only, if you outside of US and Japan and Korea, that's the only premium outlet that you're gonna find anywhere around the world. And in terms of creative industry, we've got Pinewood Studios. So this is how we do our development in that particular area.
Great. I think we're going to go now to the app, because I believe there's a question that's come up over here on the app. And let's see where that's come from and what that question is. And you can still put your questions in there on the live Q&A. We'll take any questions also from the floor. But here's that question. Amanda Clack asks, can the panel provide a sense of where China may be prepared to take on a high-risk profile in some instances, with any examples of such projects, and why these specifically are attractive to Chinese capital? So where do you think China could go in on that high risk profile? Let's ask Mr. Wang.
All right, thank you, Madam Amanda. All right, so speaking of risks for capital investment, as we know that in China, with the Chinese government, yes, there are many kind of communications with Chinese government around auditing. It's fair to say that from the regular investment perspective, of course, we're looking at ROI, right? Investors are pursuing ROI, return on investment. Capital, at the end of the day, once capital is deployed, the assets are generated. Then there is a price tag to the assets. And a post-investment, and at least when you do the valuation, then of course there are values, right, you can give or assign to the assets once capital is deployed. This is what capital is supposed to do. For Chinese government, 2 to 3 years ago, like the urban construction bond from the government, for which we carried out some auditing and assessment. So the media covered what we did. For example, urban construction capital, and the press covered this story saying that the leverage ratio on the government was rather high, so there were too many risks. But we conducted an evaluation. We found that in the latter stage of the process or project, the government was good enough to overcome those investment risks, which is the finding of our assessment. Therefore, for a government bond like that, we conducted wonderful evaluation about those risks if you are to invest into the government bond. Then when the government is making, for example, investment towards the outside, how big of a risk the government is able to assume. Of course, for investors, it is necessary to have a evaluation first and foremost. What about the direction for the investment? And what about the payback period? What about the ROI in percentage terms? I'm sure those smart investors will all conduct this due diligence. So in case it is government assets implicated, I think the government is putting more emphasis on security instead of on yield. Because as we can see that this year, the central government has promulgated a document mentioning in particular that Chinese investors make an overseas investment and the valuation of those overseas assets. How can we preserve the value of those assets overseas or even increase the value going forward? And also to prevent the risks of those, value-related kind of assets overseas. How can we prevent the risk the assets may depreciate in value? So for RICS, yes, this is a very professional and experienced organization, as a matter of fact. But different investment has different control models, different kind of pricing models. So the final number for the value of the assets may be differentiated. Therefore, we need something standard to define the value assigned to the assets. How much exactly is it? So in Singapore versus China and Malaysia, we have different calculation models actually. So I'd like to promote RICS methodology. For sure that the working methodology and the philosophy must be very important. So the standardization matters a lot, the international guidelines. Thank you.
Can I write on to what the comment by my colleague here on the need for international standards in terms of budgeting and to be able to compare between the world region, particularly when you go international. You want to compare, your investment in your own country and what is in your destination that you are targeting for. For that reason, I think just about 18 months ago, there is a collaborative effort by the organizations across the globe, including professional organizations from China. We introduced this what we call International Construction Measurement Standards, with a view of create consistency in terms of reporting on costs, consistency in budget, so that you can compare apple with apple wherever you go. No doubt you take regional differences, regional pricing differences, but you are talking about the same content, you are talking about the same measure. So we are now at a stage where it is gone out for second public consultation and is available for people to visit the website, www.icms.org, and you should be able to get the second draft and review that. And what we hope is that to be able to introduce this to the world market by this year in July. And hopefully with that in place, I think there will be some consistency across the globe for investors, for practitioners, for financiers, to be able to measure costs on the consistent basis. So I think I want to take that opportunity about the need for international standards. Thank you.
Okay, let's quickly go to another question. We just got a couple of minutes left. We took that one from Amanda, and I want to go to another one coming up on the screen right now, which really talks again about transfers, because someone asked, China's recently placed stricter control on the outward transfer of the US dollar. So how will this affect the Chinese capital investment to overseas projects? Rob? I think we should say not how will this affect. Why don't we just say will this affect?
Well, I think we have actually answered that question a little bit earlier. Again, I agree with my fellow panelists that it is the trend of Chinese capital going abroad is really, it's an unstoppable trend. I think what the capital control that government has put in place is mere speed bump. It's really to slow things down so things don't run at a fever pitch. It's a little bit big brother about it because I think they are worried that some of the investment going abroad is not as rational or, in your words, not as smart as they like it to be. So they like to slow things down a little bit and just to make sure that the capital going abroad is rational and it's well thought through. It has done all the due diligence, etc. But the overall trend over 5, 10, 20 years, that trend is certainly not going to reverse, and we're going to see more and more capital going abroad. Over the next 6 to 12 months, sure, we're probably not going to see the level of investment as we saw in 2016. But again, in the grand scheme of things, that's really just a temporary pause on what's more to come.
But may I add a little bit? Even in the next 1 to 3 years, the impact may not be that severe. The reason is, earlier we mentioned about the advancement of the capital market in Chinese industry or real estate business. And then some of the real estate company, for example, now started listed in overseas. There are 1 or 2 real estate companies want to create their REITs listed in Singapore. And then those money raised in overseas, they can still do the overseas investment business. So even this control, maybe next 6 or 12 months has some impact, but over the next short period, like 2 or 3 years, I think those capital market advancement players became more sophisticated that will sort of overcome those hurdles.
Okay, great. I think we've got time just for one more quick question over here. This is the part I really dread because it scrolls down so slowly on the screen. Any question from the audience? We've got time for just one more. One question from the audience? I've learned one thing this week, that surveyors are very shy people. So
while you're waiting, maybe I will just add a couple of points on the issues about investment and capital. I think we talk a lot about real estate, but we have forgotten about investment in infrastructure.
Yes.
I think that's very important for us. I think in investment, in fact, it's a long-term thing, and we have to be sensitive with the local sentiments as well as the sensitivity politically. For example, in the recent nuclear power plant in UK, the Kingley Point thing, when Cameron came into power, he was very gung-ho. He agreed to set up. When Theresa May took over, he said no, he put a stop to it. But after a while, reconsidered, and thankfully, he has she has agreed to proceed with that project. And so there is certain sensitivity with regards to the local sentiments on the project and I think in this regard, Chinese, apart from capital, you need to communicate, your real intention. I know Chinese have got good intention about goodwill, about creating jobs, about the welfare but I think we have not been able to articulate well enough at the international market. And I think that continuous articulation is important. Second thing, with the understanding the local law or bylaws about respect for historical building. You cannot buy it up and then you want to tear it down. You have to understand the local requirement with respect for historical building, conservation and so on. And I know there is a project in Spain, I was told, in Madrid, where the Chinese developer bought it and then thought that they can tear it down and build a huge, and then the authorities came in and that project has to be changed. So I think these are some of the issues, I think, for Chinese investors and capitalists. I think they got to really understand some of the local issues when they go investment overseas.
Well, when you're speaking of articulation, that's why it's so important to have you here with us and all of you as well in creating a conversation that's not divorced from each other, but one that's cohesive and flows in one direction. It's been a great pleasure having you all on this panel. I mean, Wang Yongxing and Rob Young and Hisham, Mohammed, Yusof and Dr. Ong, and of course, Professor Deng, who opened up this panel for us. It's been a great pleasure, and thank you very much.
Thank you.